Hello everybody, welcome to this live streaming event from LCG through YouTube. Today we're looking at the German DAX index. If you just look at the chart, I'll show you in just a minute, you'll see it was a huge up day yesterday. I believe it was the largest single daily gain in a year and a half. The DAX was up around 2%, as was the Euro Stoxx 50, as were some of the other core indices in Europe. France even more, I think. It came at the same time that French government bonds, most notably the 10-year government bond in France, dropped below zero for the first time, so fell into negative territory. And generally, what drove this whole situation was the fairly significant change in stance from, you guessed it, a central bank, this time the European Central Bank and Mario Draghi, basically saying that if conditions stay as they are, then the European Central Bank will look to start to add stimulus again, starting with rate cuts, but he fully opened the door to more quantitative easing. And that basically means the European Central Bank buying up government bonds. So the fact that yields dropped yesterday quite significantly, it's no surprise. It's not people going for a safe haven. It's basically investors front-running the central bank. The investors are buying the bonds now because it looks like the central banks are going to buy bonds later, and the central banks are not price sensitive. They're not trying to make profits on the trades. They're just buying them at any price. So investors, savvy investors, buying in now in expectation of that happening in the future. Bond prices are going up, and at the same time equity prices are going up because lower interest rates are good for borrowing costs of companies. And it just makes, apart from the capital appreciation, i.e. the price going up on bonds, the rate of interest that you're earning on the bonds is getting less and less attractive, and so that makes equities relatively more attractive. It's that same whole argument, but it looks like we're back into QE territory again. I'll flip over to the, so you can see this price chart behind me, obviously in the LCG Trader platform. This is the huge candlestick chart I was talking about yesterday. A large bullish engulfing bar after not at the end of a trend, but at the end of a consolidation. What was nice about this, and why it's a pretty powerful pattern, as you can see, we're putting in a series of lows here. It made a false break intraday, came down, tested the 12,000 number, and then rallied to the top side and closed above the round number we had in mind, which was the 12,300 as potential resistance, closed above there. And even above that previous peak. So the next challenge is a roughly 12,500. If we zoom out on the chart a little bit here, you can see it tested the old peak before. The trend has been bullish, but of course there's a series after that big drop at the end of last year. There was a series of resistances to get through on the way up, and at this stage, it was looking quite worrying. We put in the support here above 11,800, and there certainly will have been a bunch of traders, quite legitimately so, shorting the breakout lower below 11,800 in expectation of a bigger drop and a break of this trend. But 2 days later, we rallied to the top side, testing 12,000 again. And really since these couple of days here, in I believe that was late May, we've just been setting up basically yesterday's scenario. So obviously you could probably argue that in the know insiders buying into that false break lower in expectation of this announcement we got from the central bank. So one extra consideration is we've had a false break lower, pushed to the top side. Looks like the bullish trend that we can see in place here since the beginning of the year is back intact. A confirmation of that will be when we break through this level, but obviously it's it's later in the game. Once we get through there, prices are higher. We ideally want to recognise that the trend is moving higher before that stage. Another bit of information here. If I zoom out the chart even further, we get up to 13,600, which is roughly speaking the record highs for the DAX. If we draw a Fibonacci here, which I don't always do, but it's getting a feeling for how this retracement's going. That's much more levels than I expected. If I get rid of most of those, apply that as the default for next times. Oh, There we go, at least I've got it still. You can see here that this 12,300 corresponds quite nicely with the 61.8% Fibonacci. So if you believe in Fibonacci, it's roughly a 2/3 retracement of this decline. We're now breaking back above that 2/3 decline. Really, if this is just a retracement and this is the downtrend and we're going to eventually resume the downtrend, we need to hold this area, roughly speaking, the 12,300. Roughly speaking, which is the 61.8. So it's not, these are not exact science, so these highs probably the next level that needs to hold for this to just be a dead cat bounce, if you like, and for us to turn lower. So quite a critical area. If we continue to move higher, then notable, I think, that if you do add the next significant Fibonacci level, the 76.4, lands pretty nicely on this previous peak around 12,800. So that would be the next logical upside target. But in my feeling, if we're moving in that direction, we're probably going to move up and test the big round number of 13,000 as well. So put it all together, the picture for indices suddenly looking a lot more favorable. Of course, there's all sorts of things that can rock this, trade war concerns and the like, but it looks like trade war situation should eventually be resolved, maybe before the 2020 election of Donald Trump, election campaign rather, and it looks like these technicals are looking good, and the ECB now looking at cutting interest rates again, which is great for the DAX index. So that's all I had to add for today. I hope that was useful. Good luck for trading the rest of the day. Jasper signing out.